Ladies and gentlemen, good day and welcome to the DoubleLine Income Fund webcast call. Today's conference is being recorded. At this time, I would like to turn the conference over to Ron Riddell, President of DoubleLine LLC. Please go ahead.
Well, thank you, and good afternoon, and welcome to the DoubleLine webcast with Ken Shinoda. The title of today's webcast, Last Call. I want to highlight some thought leadership in the media coming up. The first one is DoubleLine's Roundtable Prime series that will be available on YouTube. It is with industry titans like Jeffrey Gundlach, Jim Bianco, Daniel DiMartino Booth, Ed Hyman, and David Rosenberg. It's moderated by Jeff Sherman, and it will discuss the macro markets and best ideas. That will be available again on YouTube in the early part of January. Our very own Ken Shinoda on this webcast. He has his channel 11. It's available on YouTube as well. Please go and listen to some of those webcasts. And we have two podcasts, the Sherman Show podcast, the widely acclaimed podcast, also available on YouTube. But both the Sherman Show podcast with Jeff Sherman and Sam Lau, and also the Monday Morning Minutes podcast with Sam Lau and Jeff Mayberry are also available on DoubleLine.com, iTunes, SoundCloud, Google Podcasts, Spotify, and Stitcher. The Monday Morning Minute podcast is a great way to get a recap of the week ahead and the previous week and macro and markets. So with that, I'll turn the call and the webcast over to Mr. Ken Shinoda.
Thanks, Ron. Appreciate it. Hi, everyone. Hope everyone had a great year as we look to close out the year here. I'm going to go over some of the information, and I'm going to talk about some of the fundamentals behind the assets that we hold, why investors may look at it are a variety of reasons. One is, of course, to gain a source of income. Portfolio has a SEC yield today north of 5%. And another reason is that it has a very low interest rate risk. Many of the products within securitized credit that we focus on don't carry much interest rate risk. That can do potentially well in a rising rate environment. And of course, last but not least, it's a source of diversification to add yield to maybe as a complement to a more traditional core fixed income type portfolio, fixed type portfolio. Duration is very low, sub 1 year, weighted average life of 5 years or so. And the floating rate securities in the portfolio are also very high at about almost 50% of the portfolio. We target more of the below investment grade type securities, triple B, double B, single B, and even some of the equity type tranches. So it's more of a credit portfolio. Majority of the assets exposure is in credit, almost 80%. But it has more yield, but it also will have more volatility. So investors must take note of that as they hold it within their portfolio. As we move on to returns, it's been a year where some parts of the interest rate curve have risen. The long end has actually not moved that much, the long bond. And as a function of that, you can see many of the sectors that had really great performance last year, like investment grade and agency mortgages and treasuries, are where you're seeing the negative returns this year. And as you move out into the credit world, you see that the riskier credit has done very well, and especially floating risky credit, CCC bank loans. The big returns come from some of the sectors that were hit harder last year, like commercial mortgage-backed securities and ABS. They're up, CMBS is up over 10%, ABS is up over 20%. Non-agencies and CLOs, which fared better last year, are up about 470 or so. And what's dragging down a little bit of performance is the agencies, which are down about 2% because of a combination of interest rates and the forward curve. And I'll get into a little bit of that later. We think there's some upside in some of the agency CMOs that got hit this year with the forward curve repricing. As prepayments slow, those securities can do very well. I'll start with some macroeconomic thoughts. Inflation is, of course, on everyone's mind, so I want to spend a little bit of time talking about what my views are on inflation. But we'll start, of course, with growth. This is real GDP forecasts, which are typically pretty stable throughout the year. Often it seems like they come down through time. And now they've become obviously more volatile with much more uncertainty out there. But the big theme is that It seems as though growth expectations have peaked and are coming down, but the market, at least economists think that growth will still remain elevated next year relative to history. So while it's going to come down off the highs of 2021 with all the stimulus, that it's still going to be probably a little bit higher than it has been, thanks to all the fiscal stimulus, the low rates, and all that kind of rolling along maybe through next year. All those benefits rolling along through next year, as of course as a function of the inflation that we're seeing today, that Chair Powell decided is not so transitory anymore, and probably wishes he'd never used the word transitory. The market is the Fed's going to taper asset purchases. We'll see what they have to say this week. I think they'll probably accelerate the pace of taper, and it's likely that they start hiking rates next year. So far, the bond market thinks that there will be one hike by the summer of next year, June of 2022, and maybe even to 2 hikes through next year. I think that's probably right. I think that inflation will stay elevated. The Fed's going to hike interest rates sooner than some had expected, even 12 months ago, even 6 months ago. And as a function of that, you are seeing the long end of the yield curve come down, as the bond market's expecting that hiking to stunt growth at some point in time. What really differentiated the stimulus that we've seen during the post-pandemic era, let's call it the QE4, is that when we had QE 1, 2, 3, Operation Twist, it was just monetary policy. Just, keep rates low, maybe buy some bonds, maybe sell some short-term bonds to buy long-term bonds in Operation Twist. What was really unique about the stimulus that we've seen after the pandemic was the combination of QE and fiscal. And you can really see that if you look at disposable income, which tends to move upwards and to the right as the population grows and people make more money through time as wages rise. But there's these big spikes. This is kind of this. A lot of this is the stimulus checks that got paid out. And so what people did is they took the stimulus checks and they bought stuff. And they couldn't go out to restaurants because of the lockdowns, or maybe go on vacation, but they could buy goods. Jeffrey just used this chart in his webcast last week, and I really thought it was a great chart, because it's pretty remarkable how it took over 10 years to get this growth of about 50% in goods demand. And then after the stimulus, we saw that about that same percentage growth within a year and a half. And this is a function of those direct stimulus payments going to the purchase of goods, which is not shockingly why we see goods inflation. All of a sudden, a lot of demand, and the supply of goods just wasn't there. Part of it thanks to pandemic shocks. So when you take a look at inflation, you break it down between its 3 components of core CPI. You've got core goods, which we just talked about. That's where a lot of that near-term inflation has come from. The other 2 parts are, of course, shelter and services. We think at DoubleLine that shelter, we've been talking about it for a while, that shelter is going to go higher. Shelter inflation is going to go higher just based on home price appreciation. You're finally starting to see some of that seep through. That's probably going to stay with us for some time now. There's just not much supply of housing, both multifamily and single family, and that's going to continue the pressure on shelter costs. And then services. Big component of the services is, of course, wages that are on the rise, and I think they're going to continue rising based upon some demographic trends that are out there and some structural changes in the market. We'll get to that too. So I think core goods inflation does come down. Eventually, these supply chain issues resolve themselves, but I think some of that's going to be offset by an continued increase in shelter costs and services costs. Here's a look at if you took shelter the way that they report it for the CPI, which is kind of weird for people that live in homes. They go and they survey, where do you think your house could rent for? But if you just took home price appreciation and you put it in place of that weird calculation, CPI would actually be significantly higher. And so I think to keep watching that shelter component of CPI, I think it's going to continue to go higher. Here are apartment rent growth. This is also from the Total Return webcast that I thought was a good slide. It shows that we were kind of bumping along, kind of on trend. It goes up and down seasonally, and then we've kind of made this big move up and to the right. on national median rent. This is for apartments. It's the same story for homes for rent, single-family homes for rent. There are just not that many homes available for rent. There's not many homes available for sale either. And so, not shockingly, you're seeing some of the biggest increases in rent for single-family homes across the nation. One of the things that happened during the global financial crisis is, people that were underwater on their mortgages walked away from their homes because they could rent the place next door for half price. Well, unfortunately, you can't rent the place next door for half price. Your mortgage is probably half the cost of rent for the place next door. So not surprising, we're actually seeing many people not defaulting on their homes as they lose jobs because they've got a lot of equity in their house. And I'll get to some of that information a little bit later too. So we talked about shelter. That showed that shelter costs are going higher. Now let's talk about wages, which will be an input into service costs. There is a supply-demand imbalance out there right now. There are more job openings than people looking for jobs. And simplistically, that's going to, I think, lead wages to continue to have pressure upwards until more people come back to the job market. So the question is, will they come back? Here you can see, this is the Atlanta wage growth tracker. It shows you that it's, it's up around 4% right now. And the big question is, will some of the people that have left come back to the workforce? And the big portion of the workforce that may not come back, I think, are the baby boomers. These are some slides from Jefferies that I thought were interesting. They show longer-term trends of employment to population ratio and labor force participation. And you can see that labor force participation and employment to population ratios peaked in the 2000s, and there's been a downward trend. It kind of goes up and down with the boom and bust cycle of economic cycles, but you can see that it's been continuously declining. One of the reasons that is that as the largest percentage of the population, which are the baby boomers, ages, they go into retirement. And you can see that since the start of the pandemic, you've got a big shift of the baby boomers moving to the 65 plus cohort or bucket. And that bucket tends to have very low employment to population ratio. So about 20% of that demographic is still employed. It makes sense. People want to go into retirement. And one of the things that we call the pandemic is the great accelerant. It sped up a lot of things that were already happening, like the move to e-commerce, like people wanting to buy single family homes. And one of the things that it's also sped up, I think, is retirement. There's a survey I saw the government started putting out after the pandemic, and it was asking people that were unemployed, why are you not going back to the workforce? Asking people that are unemployed and not in the workforce. And something like 42% of them on the most recent survey said it was because they're going into retirement. Their stock portfolio is up, Social Security is on the rise, and maybe they're moving to a cheaper place. And that's why you're seeing a lot of migration into low tax states like Florida and Arizona and Nevada and such. And so here's labor force participation at age 55 and greater. Look at the big move higher in participation. This was the baby boomers, and it was a huge move higher in this participation rate. And now that's going to go the other way, I think. And it's already come down. And you can see in kind of like it bounces around, but I just don't think that age cohort is coming back. And I think that's going to maybe put continued pressure on wages. So something to watch, shelter and services. As the goods inflation comes down, those two components of inflation can maybe take up the slack. I don't think we're going to see hyperinflation necessarily, but I just think we're going to see elevated inflation rates relative to the pre-pandemic era. Looking at the interest rate curve, it's been a story of flattening. The short end has come up as the market starts expecting a Fed hiking cycle. The long end the very long end especially has come down. Maybe signaling to the market that the Fed raising rates is clearly not accommodative and not a good thing. And then we're going to see a slowdown in economic activity as a function of the punch bowl getting taken away. Real yields as a function of where inflation is are very negative. This has been accommodative for many risk assets out there. And, I guess the question is, at some point, do these move higher? That would mean nominal yields would have to go higher. Maybe not. we have had periods of time in the U.S., especially after World War II, where very high levels of debt needed to get paid down, and real yields stayed negative for long periods of time. Not saying that's my base case, but I'm just saying something to think about is one would think with inflation where it is, even if it comes down, nominal yields will normalize and move back higher to pre-pandemic type levels. But another scenario could be a more repressed environment where real yields stay negative for longer periods of time. And just thinking about active management of fixed income being very important, and using the income portfolio to add a little bit more yield without not much duration. That's where the income portfolio, I think, is interesting for investors. So now I'm going to talk about some of the fundamentals for the underlying assets. So on average, people have been a little bit more conservative recently. They have been saving a little bit more money. That you saw some bizarre spike with the stimmy checks. And as people have gone through the stimulus checks, we're kind of back down to the savings rates that we had prior to the pandemic, around 7%. We also saw that incomes were rising earlier and wages are rising. This is all net positive for the consumer's ability to pay down debt. So not surprising, delinquencies on consumer loans are very low. Delinquencies on credit cards and auto loans and student loans and mortgage loans are low. We have seen a recent uptick in the delinquencies on the worst quality borrowers, subprime borrowers, low FICO borrowers. This is not unexpected. These are borrowers' credit performance going back to normal. If you looked at subprime delinquencies, they got really low because everyone had the stimulus checks to pay down their debt. As the stimulus checks are now in the rearview mirror, the credit performance of down in credit borrowers is going back to normal. This is something I talked about on the last webcast, is don't extrapolate the things you see currently. There's a lot of stuff that's being distorted during the pandemic because of the QE and because of the stimulus checks, and credit performance of really bad credit borrowers, of course, is one of those things. But we have a diversified portfolio, and the consumer delinquency is very low. The other thing going for the consumer is that because interest rates are so low, the debt service cost relative to income is extremely low. It's at low levels we haven't seen in like 6 decades because of how low things like mortgage rates are. And so that just means that there's more income to spend on goods potentially, which is of course positive for things like retail sales. And we have seen strength in retail sales. One thing to note is that strong retail sales number, some of that was inflation. So at some point in time, you have to look at like real retail sales, taking inflation aside, as spending power decreases with inflation continuing higher. Home prices, of course, as we all know, have been super strong. We've been pretty bullish on housing even before the pandemic, really driven by our view on a lack of supply. There is just not that much supply of homes, and so home prices had went up 20% on an annualized basis last year. We think that slows. We could have a surprise to the upside year again this year. I think kind of street consensus is like high single digits, low double digits type home price appreciation or HPA this year, and then we'll slow down the following year. There's definitely been a divergence. The suburban areas have done better than dense urban areas, not surprising. You're starting to see a little bit of a change in that trend as people go back to the cities. And of course, with home prices up, home equity is at an all-time high. And that's really good for credit performance. People don't walk away from equity. And you're seeing that as you look at information that we get from servicers that we follow. On the left-hand side here is the supply of homes, off the lows, but still super low. We were at 1.5 million homes going into the pandemic. We're now out around 1 million homes, and the population just keeps moving up and to the right. And so with this lack of homes, that's just really helps drive that positive home price appreciation. You're starting to see some new homes being built. New inventory is the beige line, but that's being curtailed by supply chain issues with materials and labor costs. And that's unfortunately making it so the supply still stays low, which is of course good for housing prices, but bad for people that are looking to buy homes. And who's looking to buy? Well, it's the millennials. What really hurt us in 2006 was, and this is the chart on the left-hand side, this shows you the different kind of generations. And in '06, Gen X, which is my sister's generation, a little bit older than me, they were hitting. We picked 33 years old. We said that's kind of around when people starting new households and buying homes. And as you can see, it was on the decline. And now, from a demographic standpoint, you're hitting the millennials, second largest generation since the baby boomers, and they are, starting families or creating new households and buying homes. And right after that, you've got the next generation. I don't know. This one says post millennials, and that looks pretty big too. So there's buying there's buying demand that's coming with limited supply, and that's a pretty strong supply demand technical. Affordability is also still not that bad, even with home prices up a lot. Affordability is calculated by looking at median income, median home price, the mortgage rate, calculating a mortgage payment, and then looking at that mortgage payment relative to incomes. And with mortgage rates still very low and incomes on the rise, affordability, even though it's come down a lot recently with home price appreciation, is still better than it was for much of the time period before the global financial crisis. And that also bodes positively for home prices. So I just wanted to touch on mortgage spreads. They got super tight early this year, and we went underweight in many of our portfolios. They widened into the summer, where we added back. They rallied, they tightened since then, and then with some more taper fears recently, they widened again. So now they're sitting on kind of 5-year long run average spread right now. We have a little bit of pass-throughs, maybe like 2-3% here, some treasuries for liquidity. Where we get our high yield opportunities in the mortgage space are in things like IOs and POs, interest-only securities and principal-only securities. And some of those securities where we're focusing on are the interest-only securities that do well when prepayments slow. And recently they've gotten hit a little bit because they have coupons that flow inversely to short-term rates, and short-term rates have repriced higher. But with a lot of that repricing in, I think, and prepayments slowing, this shows you prepayments of the aggregate agency universe, I think the outlook for some of those agency securities is pretty good next year. So I think that's one of the things that we'll do. Underperformed a little bit this year relative to some of the other credits that did really well, but I think there's a lot of upside next year as prepayments continue to slow. Many people have already refinanced if they could have refinanced. So that's the consumer, that's housing, and a little bit on agencies. And now we'll move on to commercial real estate and transportation, which we have exposure to in the ABS market. Commercial real estate prices driven by cap rates. Cap rate's a function of the risk-free rate and cap spreads. Cap spreads are the beige. You can see they blew out in 2020. They've come back in. So even though risk-free rate has risen, cap spreads have tightened, and cap rates have come down. And one of the things that really supported the commercial market was that the banks weren't going under. Lending came back pretty rapidly. And so with an abundance of borrowing capacity, at least for high quality borrowers, that is, the commercial markets have actually gone up in price. Pretty remarkable. On the left-hand side shows commercial price indices, and it just looks like a hyperbolic move upwards, low rates, and some sectors, a lot of demand for multifamily. If you think about multifamily, you can pass through inflation through rent increases. Multifamily and industrial doing really well. Here you can see that even office as a basket and retail as a basket has moved higher in price. But it's, of course, not all office, not all retail, not all real estate is equal. It's all about very location dependent, property dependent. Another thing we've been looking at, last time we had a webcast, this showed multifamily prices change year over year. A lot of these ones in the bottom were to the left. A lot of these big metros like LA were negative price change. And that's all flipped. So not only you can see New York is the only one left here, and I bet you that's going to flip soon, because as passage of time and the healing of markets and the lack of supply of housing and rents going higher, it's helping to propel the prices of multifamily properties up as well. So that's something that's definitely changed over the last 12 to 24 months, is that divergence that you saw. It's still there. The big metros aren't up as much as Phoenix, Jacksonville, Atlanta, so on and so forth. I'll note a lot of these are those low tax states that those boomers are maybe moving to. But just an interesting thing to look at. So from a fundamental standpoint, the underlying assets behind our commercial securities, the prices seem to be moving higher. It's a positive trend. This is multifamily rent collections. It's a little bit down from last year, and I think part of it has to do with the stimulus checks in the rearview mirror. But it's down very little. I mean, look at November, we collected 93.6%. Last year, we collected 93%. These are really strong numbers. Multifamily rent collection right after the pandemic surprised us to the upside. And, I guess you needed a place to live because of the lockdowns, but also it was that very unique use of the fiscal stimulus to send out those checks that aided a lot of the recovery in the economy. And as that goes away, of course, growth expectations also seem to be coming down as well. The big debate out there, multifamily is like a rock, industrial is like a rock. Even some parts of the hospitality market are doing very well, but office is kind of the uncertain one. What you're seeing is there's really good demand for kind of new office space, brand new buildings with a lot of amenities. Companies are eager to lease those out now. If you look at absorption rates with lease data that we see, and it's kind of old office buildings that are lagging out there right now. And there's definitely some divergence across geographies because of the different behavior of different states with their lockdown measures or vaccination requirements. And we get this data from Castle, which is when you go into your office and you take your badge and you scan yourself in to go up the elevator, it collects data. And not surprising, certain metros in Texas, for example, and maybe Florida, actually, I don't know if Florida's actually not on here, but it's Texas, we got on here, Dallas and Houston and Austin. You can see that almost 50% occupancy of workers that are going back, which is up big, of course, from a low of 20%. And in the other metros, like LA, for example, office utilization is way, way lower. And started to recently see an uptick, but I'm going to bet this is going to come down with the Omicron variant. You're already starting to hear about certain companies saying that they're holding off on back to office. So jury's still out on office space. I think the way that we use it's probably going to change. You can find a bull and a bear and argue both sides of it. Hotels have largely recovered. On the left-hand side is a year-over-year change in occupancy, RevPAR, and revenue per room. And you can see that on a year-over-year basis, everything has improved, right? Everything's improved, obviously off the lows. It was just over a year now that we had announced the vaccines came out in November of 2020, the vaccine announcements, and people started feeling more comfortable traveling. But then as you look across, urban versus suburban versus near airport versus resorts, there's a different story. And what you're seeing is basically office business-related travel is not recovering as much as leisure travel. So near airports and near those big urban areas, you're still on a 2-year basis, you're still down. And you can also see that if you look at transportation data, we look at TSA data, we have some aircraft leasing type exposure in the ABS portfolio. And the gray line is last year, which of course was way down from 2019. And things have improved a lot. I mean, we're not back to 2019, but the TSA traveler throughput information is up a lot. And we were putting this chart together and we were guessing that gap is probably business-related travel is that difference. And we have to wait and see next year if that business-related travel continues to pick up. But the trend clearly has been positive. Omicron variant probably gives us a step back, maybe not, depending on how people change their behavior. People are just, have learned to live with it, which is kind of what's happening too. But nonetheless, something interesting to watch. So broadly speaking, improvement in commercial real estate fundamentals. Broadly speaking, an improvement in some of the travel related sectors that we invest in. Consumer fundamentals also looking good. Fundamentals look pretty decent everywhere, even in corporate America, which is my next stop. As we look at on the upper left-hand side, U.S. high yield default assumptions come down. U.S. bank loan default assumptions have come down. I don't have a chart here, but if you looked at debt service coverage by looking at earnings and EBITDA, obviously very high, as we saw third quarter earnings come through very strong. And with debt rates or bond yields being so low, companies have borrowed at really low rates. And the debt service coverage is pretty strong right now. So the fundamentals look pretty good. Valuations, of course, are another story. But one place that still looks a little cheap that we've been adding to across portfolios is BB CLOs. We've had some near-term supply through the end of the year that's kept spreads wide. So we've been adding some BBs across many of our accounts and strategies at DoubleLine. And last but not least, the maturity wall. A lot of companies have borrowed. They borrowed out the curve. They've borrowed. They've refinanced. And so, at least in the near term, as we look at high yield, there's no pending maturity wall here until about 2025. So, spreads in some sectors are tight. They've widened recently with a little bit of vol, but the fundamentals look pretty good. So we're pretty constructive on the performance of credit from a loss standpoint. Doesn't mean we won't see volatility. I do think we see volatility because the punch bowl is going away. That's why the name of this webcast was Last Call, with a picture of money being printed in front of the Federal Reserve. The money printing and the punch bowl is being taken away. We're going to find out this week how fast that's going to be taken away. I think that's going to create some volatility, which of course creates opportunities. So I think it's a good time to have some dry powder to try to buy some interesting assets out there, whether they be equities or fixed income type assets. But patience I think will be a virtue next year. Okay, some questions about the securitized recovery. Is there much left? Securitized assets, it's all about relative value. So everything's up. Everything's up. Definitely certain pockets of securitized are still wide relative to their all-time tights. Some pockets have actually widened recently because of supply, BB CLOs being one of them, some parts of the CMBS market, even some parts of the RMBS market. So things are wider than they were, let's say, 2-3 months ago. And how are we able to get 1 year, sub-1 year duration? A lot of floating rate securities, 45% in floating rate securities. Some securities that we believe have negative duration. They do well as rates rise, as the economy improves. Also, those IOs have a negative duration as rates rise on the long end. Prepayments slow down. Those bonds can go up in price. So that's how the portfolio gets to that very low duration. What are the changes that have been made? We've moved some exposure into the BB CLOs. We've also moved some exposure into those IOs that got hit this year that I think can do well next year. A question about mortgage duration extending. That's on generic mortgage pass-throughs. If the 10-year Treasury yield rises, people's expectations of prepayments go down, and those bonds will extend. We don't have too much of those kind of generic mortgage pass-throughs in there. What we do own are a lot of RMBS credit, and those have very short duration from a combination of either being floating rate or structural. Liquidity conditions and structured credit right now, more than 18 months removed from the COVID sell-off. Liquidity going into the end of December is going to be worse than the beginning of December. The end of the year is always a slow time of the year, but liquidity has been very good in over the entire year of 2021. A lot of supply. I think we had record issuance across many parts of securitized credit, and it was all bought and purchased and taken down by end accounts. A little bit of spread widening in Thanksgiving just because of a really heavy calendar, but liquidity has been pretty good. Broadly speaking, in fixed income, what you have now is that Wall Street doesn't like to balance sheet securities in great size. So when we see a little bit of volatility, liquidity is fine. When you see a lot of volatility, all of the street runs for the hills or hides under their desks and gets a tap on the shoulder not to buy. And I think that's going to create periods of increased vol, which are good buying opportunities if you can gain exposure. Sometimes it's hard to buy if that people willing to sell. Are you invested in TIPS? We are not invested in TIPS. Are there any concern over mortgage modifications? Not at all. The mortgage market has gotten really good thanks to a decade post global financial crisis at dealing with loan modifications and things like that. And one of our bull cases for mortgage securities right after the pandemic was that forbearance had been used before during times of natural disasters like hurricanes, and we've seen it work. And people cure and go get jobs again, and economy heals, and it's now part of the playbook, I suppose. And that's why we're going to see very low risk profile. We're going to see really low losses in the mortgage sector. Was a drawdown for the strategy during 2022 within risk profile expectations? I think it was, nobody could have predicted how the pandemic, or even predicted the pandemic, but like how it uniquely affected markets' expectations of behavior in commercial real estate and travel and things like that. So I think the two hardest hit parts of the portfolio were commercial mortgage-backed securities and asset-backed securities linked to aircraft leasing. And those were probably the two hardest hit sectors within securitized. You could have gone into kind of the high yield market and look at things like casinos or hotels and cruise ships and things like that. They also got hit really hard. So that was a unique environment. I think it was exacerbated by the lack of liquidity I just described. And part of that was also exacerbated by that week when the prices were declining was the week when everyone was fleeing their offices and they were going to work from home. And so the trading desks weren't, set up sitting next to each other, which decreased risk appetite, not only on the sell side, but also on the buy side. So I think all those things came together for the perfect storm last year. So with that, thanks everyone for joining. I hope everyone has a great end of the year, holiday season, and stay healthy. And we look forward to our next call for the DoubleLine Income Fund in 2022.